Hello students and welcome to the lecture. So students, as we know that we are covering the banking awareness practice questions, right? And this is going to be our part 4. So basically in this lecture, we will do the same thing, like we'll practice some practice questions and at last we will see the summary of all of them. Okay. But before starting them, there is a small disclaimer that is presented over here. The disclaimer is like, the images used in a slide deck are for educational purposes only. We respect the intellectual property rights of the original creators and owners of these images. If you are the owner of any of the images used in this deck and have any concerns or issues, please contact us at sathee@iitk.ec.in and we shall remove the images. Now, let's begin with the first question. An investor or speculator who subscribes to a new issue with the intention of selling them shares soon after allotment to realize a quick profit is called bull, bear, stack, short, tall. To answer this, you have 10 seconds, then I will provide you the answer. Time starts now. Time's up. Correct answer is stack. Go by explanation. The stack is an investor or speculator who subscribes to a new issue like an initial public offering or IPO with the intention of selling the shares shortly after they are allotted in order to realize a quick profit. The stack typically take advantages of initial price surge that often occurs after a new stock is listed. Therefore, the correct term for someone who subscribes to a new issue with the intention of quickly selling a profit is called the stack. Question number 2. On which of the following dates does a bank publish its balance sheet? March 31, April 1, December 31, January 1, none of these. To answer this, you have 10 seconds. Time starts now. Okay, the time's up. Correct answer is March 31. Go by explanation. Banks in India, as well as in many countries, typically publish their balance sheet on 31st March each year. This date marks the end of the financial year for banks. Prepare their financial statements, including the balance sheet, to reflect their financial position at that point in time. Other state mentioned such as April 1, December 31st, January 1, do not align with the standard practice for banks to publish their balance sheets. Now the question number 3. In which stock exchange currency futures trading was first started? BSE, NSE, MCX, SX, all the above had the trading simultaneously. None of these. To answer this, you will have 10 seconds and your time starts now. Okay, the time's up. Correct answer is NSE. Go by explanation. Currency futures trading in India was started on National Stock Exchange. The NSE introduced currency futures in August 2008, allowing participants to hedge against currency fluctuations and engage in this speculative trading. Thus, the first stock exchange to start trading currency futures in India was NSE, National Stock Exchange. Question number 4. What do you mean by term consortium? Options are: when more than one bank allow credit facility to one party in coordination with another under a formal arrangement. In a consortium, more than two persons together take loan from one bank. In a consortium, banks provide loan only to the poor. Both A and B are correct. None of these. To answer this, you will have 10 seconds. Time starts now. The time's up. Correct answer is A. Go by explanation. A consortium typically refers to a formal arrangement in which multiple banks come together to provide a credit facility to a single borrower. This is often done to spread risk and ensure that larger financial needs could be met without overexposing any single bank. So A is actually describes a consortium in the context of banking and finance. Move forward, question number 5. The Reserve Bank of India keeps on changing various ratios frequently. Why is this done? To keep inflation under control, to ensure that the Indian rupee does not lose its market value, to ensure that banks do not earn huge profits at cost of public money. Options are only 1, only 2, only 3, 1, 2 and 3, none of these. To answer this, you have 10 seconds. Time starts now. The time's up. Correct answer is this one, D. All 1 second and third. Go back explanation. The Reserve Bank of India changes various ratio rates like repo rate, reverse repo rate, cash reserve ratio, etc. for several reasons, including to keep inflation under control. By adjusting these rates, the RBI could influence the money supply in the economy, helps in managing inflation levels. To ensure that the Indian rupee does not lose its market value, changes in rates could affect the value of the currency as they influence investment flows and overall economic stability. To ensure that the banks do not earn huge profit at the cost of public money, by regulating the interest rate and other financial metrics, the RBI could prevent banks from exploiting their portion to generate excessive profit, thus safeguarding the public interest. So D is the correct choice. Deficit financing increases when rate of money inflation, rate of money deflation, rate of devaluation, all of the above, none of these. Again, you will have 10 seconds to answer. Time starts now. Time's up. Correct answer is A. Rate of money explanation. Go by explanation. Deficit financing refers to the practice of funding government spending by borrowing or printing more money rather than relying solely on revenue. This can lead to the rate of money inflation. When government increases spending through deficit financing, often results in an increase in the money supply, which could lead to the inflation if the economy is at or near full capacity. More money chasing the same amount of goods tends to increase prices. Therefore, the primary and most direct impact of deficit financing is an increase in the rate of money inflation. Question number 7. Which is not a monetary money measure to control the inflation? Soft loan policy, hard credit policy, tighten the regulations of money issue, reduce the quantity of money, none of them. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is soft loan policy. Go by explanation. Monetary measures to control inflation typically involve strategies aimed at reducing the money supply for increasing interest rate to curb spending. Here is the breakdown of options like soft loan policy. This generally refers to providing loans at lower interest rate, which could increase money supply and spending, potentially exacerbating inflation rather than controlling it. Let's move ahead. Question number 8. Which is the monetary measure to control the inflation? Increase in taxation, decrease in taxation, soft credit policy, hard credit policy, none of these. To answer this, again you will have 10 seconds and I will give you the answer. Time starts now. Time's up. Correct answer is D. Hard credit policy. Go by explanation. A hard credit policy involves tightening credit conditions, which could including measures like increasing interest rate or restricting the availability of loans. This approach helps to reduce spending and investment, thereby controlling the inflation. Therefore, monetary measures to control inflation is the hard credit policy. Question number 9. To control inflation, the central bank should sell government securities and decreases bank rate, sell government securities and increasing bank rate, purchase government securities and increase bank rate, purchase government securities and to decrease bank rate, none of these. To answer this, again you will have 10 seconds. Time starts now, then I will give you the answer. Time's up. Sell government securities and increase the bank rate. Go by explanation. To control inflation, a central bank typically employs contractionary monetary policy measure involving selling government securities. When the central bank sells securities, it takes money out of circulation, which helps to reduce the money supply in the economy. This decrease in money supply could help to cool off the inflation. Increasing the bank rate, raising the bank rate or interest rate makes borrowing more expensive, encourages saving rather than spending, which further helps to reduce the demand in the economy. Question number 10. Smart money is a term used for which? Internet banking, credit card, cash with bank, cash with public, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is credit card. Go by explanation. The term smart money typically refers to the capital that is controlled by the investors who are considered to have a better understanding of the market or by those with insider knowledge. In many contexts, it is associated with the use of modern financial instruments and technology. Making credit cards a fitting answer as they are tool for managing more money efficiently, often linked with rewards and benefits. Thus, the smart money is most closely associated with the credit card. Question number 7. If the cash reserve ratio is lowered by the Reserve Bank of India, its impact on credit creation will be to increase it, decrease it, no impact, constant, none of these. To answer this, again you will have 10 seconds and your time starts now. Time's up. Correct answer is increasing. Go back explanation. The cash reserve ratio of CRR is the percentage of the bank's total deposits that must be kept in reserve with the central bank, RBI in this case. When the RBI lowers the CRR, banks require to hold less money in reserve. This means that they could use a larger portion of their deposits to make loans and credit. As a result, a lower CRR increases the amount of funds available for banks to lend, thereby increasing credit creation in the economy. Question number 12. Which of the following items would not appear in the company's balance sheet? Value of stocks of raw materials held, total issued capital, revenue from sales of the company products, cash held at the bank, none of these. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is C. Revenue from sales of the company's products. Go by explanation. Like a company balance sheet provides a snapshot of its financial position at a specific point in time and includes assets, liabilities, and shareholders' equity. Here is a breakdown of the options. First, revenue from sales of the company's product. This is an income statement item, not a balance sheet item. Revenue represents the income generated from the normal business operations over a period and reported on the income statement. Thus, the item that would not appear in the company's balance sheet is revenue from sales of the company's product. Question number 30. Currency convertibility concept in its original form originated in Wells Agreement, Bretton Woods Agreement, Taylor's Agreement, both A and B, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is Bretton Woods Agreements. Go back explanation. The concept of currency convertibility, particularly in its original form, associated with the Bretton Woods Agreement, which got established in 1944. This agreement created a new international monetary order, allowing for the convertibility of currencies into US dollars, which were in turn convertible into gold. Therefore, the origin of the currency convertibility concept in its origin form is best attributed to the Bretton Woods Agreement. Question number 14. The central cooperative banks are in direct touch with options: farmers, state cooperative banks, land development banks, central government, none of these. To answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is B, state cooperative bank. Go back explanation. Central cooperative banks serve as a link between the state cooperative banks and the primarily agriculture credit society. They provide financial services and credit to the state cooperative banks involved in an overall coordination and management of the cooperative bank sector at a central level. Thus, central cooperative banks are in direct touch with the state cooperative banks. Question number 15. In pursuance of the recommendations of Narasimhan Committee, the RBI has framed new guidelines. First, to govern entry of new private sector banks to make the banking sector more competitive, reduce the freedom given to banks to rationalize their existing branch network, set up more foreign exchange banks, to lend more easily for industrial development, none of these. Answer this, you will have 10 seconds. Time starts now. Time's up. Correct answer is A. Go back explanation. The Narasimhan Committee, which was set up in the early 1990s, aimed to address the issues in the banking sector, recommended the several reforms. One of its key recommendations was to allow the entry of the new private sector banks to increasing the competition within the banking sector. It was essentially for improving the efficiency and service quality. Therefore, correct choice is to govern entry of new private sector banks to make the banking sector more competitive. 16. Question number. Deficit financing means that the government borrows money from the Reserve Bank of India, local bodies, big businessmen, IMF, none of these. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is A, RBI. Go back explanation. Deficit financing refers to the practice where the government borrows money to cover the gap between its expenditure revenue. Primary source of this borrowing is often the Reserve Bank of India. By borrowing from the RBI, government could finance its budget deficits, which could involve issuing bonds or other securities. Thus, the deficit financing means that the government borrows money from the Reserve Bank of India directly. Question number 17. The Board of Industrial and Financing Reconstruction, BIFR, came into existence in 1948, 1986, 1987, 1989. None of these. To answer this, you will have 10 seconds, then I will give you the answer. Time starts now. Time's up. Correct answer is 1986. Just go by the explanation. The Board of Industrial and Financial Reconstruction was established in 1986 under the Sikh Industrial Companies Special Provisions Act 1985. Main objective was to provide a mechanism for the rehabilitation of Sikh industrial companies in India, assessing their viability and facilitating the necessary financial support for recovery. PIFER came into existence in 1986. Question number 18. Banks required to maintain a certain ratio between their cash in hand and total assets. This is called statutory bank ratio, statutory liquidity ratio, central bank reserve, central liquidity ratio. None of this. To answer this, you will have 10 seconds. Time starts now. Time's up. Statutory liquidity ratio is a current. Go by explanation. The SLR is the percentage of the bank's net demand and time liabilities, NDTL, that must be maintained in the form of liquid cash, gold, or other securities. This ratio ensures that the banks maintain a minimum level of liquidity to meet their obligations and provide stability to the financial system. The statutory liquidity ratio, SLR, is a correct option as it specifically refers to the requirement for banks to maintain a certain ratio of liquid assets to total demand and time liabilities. Question number 19. In terms of banking terminology, affinity cards refers to credit card that link to the special organization, credit card with zero interest rate on repayments, credit card exclusively for the bank's employments, all of the organizations, none of them. Again, you will have 10 seconds to answer. Time starts now. Time's up. Correct answer is the credit card that are linked to the special organization. Just go by the explanation. An affinity card is a type of credit card that is associated with a specific organization, such as charity, school, or membership group. This card often provides benefits or rewards to the cardholders, while also contributing a portion of the transaction fees or profit to the affiliated organization. The card that are linked to the special organization is correct. This definition accurately describes affinity cards. Question number 20. From which country the concept of credit card originated? United Kingdom, United States, France, Australia, none of these. To answer this, again you will have 10 seconds. Time starts now. Time's up. Correct answer is B. Just go by the explanation. In 1958, the Bank of America introduced the Bank American card, now known as Visa, in Fresno, California, signifying the bank's foray into the credit card market. This card was the first of its kind, a general-purpose credit card that enabled customers to make purchases at a variety of merchants and pay off their balances over time. Question number 21. The business entity that is authorized to accept cards for the payments of goods and services is called issuer, acquirer, merchant, authorized issuer, none of these. To answer this, again you will have 10 seconds and I will give you the answer. Time starts now. Time's up. Correct answer is merchant. Go by explanation. In the context of card payments, a merchant is a business entity that authorized to accept credit and debit cards as a form of payments for goods and services. Merchants set up merchant accounts with acquirers or payment processors to facilitate these transactions. Merchant is a business entity that accepts card payments for goods and services. Question number 22. The international standard which defines the shape and size of iCards is ISO, ISQ, ISO, IEC 5200, IEC 9910, IEC 14000, IEC 7810, none of these. You will have 10 seconds to think and answer. Time starts now. Time's up. Correct answer is T. Go by explanation. ISO or IUC 7810 is the international standard that specifies the physical characteristics of identification cards, including their shape and size. This standard ensures that the ID cards, such as personal identification card, credit cards, and other similar documents, have a uniform size, format of compatibility, and usability. So it is the correct answer. Question number 23. Which of the following issued by the Reserve Bank of India for sterilization of the capital inflows? Base rate system, CRAR obligations, open market operations, trade authorization schemes, none of these. To answer this, again, you will have 10 seconds. Time starts now. Time's up. Correct answer is open market operations. Go by explanation. It is refers to the buying and selling of the government securities in the open market by Reserve Bank of India to regulate the money supply and control liquidity in the economy. When there are capital inflows, the RBI may sell government securities to absorb excess liquidity, thereby sterilizing the effects of those inflows. It is a key tool used by RBI to manage liquidity and sterilize the capital inflows. Question number 24. What is sold and purchased during the open market operations by Reserve Bank of India? Government securities, commercial paper, certificate of deposit, global deposit receipt, none of these. Answer this, again, you will have 10 seconds. Time starts now. Time's up. Correct answer is government securities. Go explanation. During open market operations, RBI buys and sells government securities to regulate the money supply and control liquidity in the economy. This helps the RBI manage inflation and stabilize the financial system. Question number 25. In the context with banking, a certificate deposit is money market instrument, negotiable instrument, transferable instrument, all of the above, none of this. To answer this, you will have 10 seconds. Time starts now. Okay, the time's up. Correct answer is all of the above. Go by explanation. COD or CD. It is a type of financial product offered by banks and credit unions, possess several characteristics like money market instrument. Consider money market instruments as they are short-term investment, typically have maturities ranging from a few weeks to several years. Negotiable instrument. Negotiable meaning they could be sold or transferred to other party. This feature allows holders to transfer ownership before the maturity date. Transferable instrument could be transferred, allowing to the holder to sell or assign CD to another person or entity. Here we have finished the topic, not part for the summary. We have talked about investor types, bank balance sheet publication, currency futures trading, consortium definition, RBI ratio rate changes. Deficit financing effects, monetary measures against inflation, monetary measures to control inflation, central bank action against inflation, smart money. Cash ratio impact, companies' balance sheet items, currencies, cooperative origin, central cooperative banks, maximum committee recommendations. Required ratio maintenance by bank, deficit financing, borrowing sources, BIFR establishment, affinity card definition, credit card origin. Payment stamp sensitivity, international credit card standards, RBI sterilization methods, open market operations, transactions, certificate deposit, characteristics. So with this, we have finished this topic. Okay. Kindly revise all the facts and figures that we have discussed in this lecture and be ready for the next lecture. With this note, let's end this lecture and thank you.